SCHD, one of the most popular dividend ETFs, just announced a 3:1 share split. And it's not quite often you see that ETFs splitting their shares. In this video, we will break down what this means for you and whether now is the time to buy into this dividend ETF. So let's get started. But before we start, do me a favor, hit that like button and subscribe to the channel if you are new. As always, everything shared in this video is for informational purposes only. So what exactly is a share split and why should it matter to you? In simple terms, a share split is mostly administrative. It doesn't affect the total value of the ETF or the individual stocks within it. But why it is relevant for us? Because it can make the shares more accessible and affordable, especially for investors who don't have access to fractional shares. Let's try to understand this with an example. Let's assume there is a company trading at $300 per share, and if you wanted to invest only $100, you would not be able to buy a full share without fractional investing. So you cannot own a share in this company. In this case, if the company announces a 3:1 share split, the price per share drops to $100. So now you can buy one share with your $100. So the share split makes it more accessible for investors. The total value of your investment doesn't change, but now the shares are more affordable. Schwab doesn't allow fractional shares for ETFs, so this move makes SCHD more accessible for investors. After this 3:1 split, SCHD price will drop from around $85 per share to around $28 per share, opening the door for many investors who might have found the higher price difficult to access. So now let's get to the second big question. Is this the right time to buy SCHD? Well, SCHD is one of the most popular dividend ETF for quite some time, and there is a reason. It offers a diversified portfolio with over $62 billion in assets under management. In the last year, SCHD has delivered more than 19% return, making it an attractive option for growth and income-focused investors. What really sets SCHD apart is its strong dividend profile. Right now, it has a solid 3.5% dividend yield and a 5-year dividend growth rate of 12%. Further, SCHD has been paying and growing its dividend for 12 consecutive years, making it a consistent performer. Let's take a quick look at SCHD holdings. It holds 103 stocks, and its top 10 holdings includes giants like Home Depot, Verizon, BlackRock, Cisco, Pfizer, and others. These top holdings make up around 40% of the entire ETF. So the SCHD holding profiles looks very strong and robust. This ETF rebalances itself every year in March, so it's not easy to value SCHD the same way you would an individual stock. However, by analyzing the valuation of its top 10 holdings, we can get a clear picture of whether SCHD is overvalued or undervalued right now. Currently, a few of SCHD's top holdings seem fairly valued, while others are trading at a premium due to the market recent rally. So it is always good to be patient and not rush into buying when markets are high. So to answer this question, whether it is the right time to invest in SCHD, my take is I'm planning to add a few more SCHD in my portfolio before the split. So what about you? Are you planning to buy SCHD before the split? Let me know in the comment section. That's all for today's video. If you found this analysis helpful, make sure to like the video and subscribe to the channel. Thanks for watching, and I will see you in the next video.